In our prior episode, you may have heard Sina and Michelle talk about how there's a crypto bubble, and we briefly mentioned an asset bubble in the stock market that we didn't touch on as much, but we'll talk a little bit about that and also what you can do about the situation. You're listening to Investing Mastermind podcast. I'm Michelle Markey.
And I'm Signe.
And as you may be aware, the stock market is pretty overvalued. I'll quote a person from the Financial Times named Ruchir Sharma, who said that America is overowned, overvalued, and overhyped to a degree never seen before. And I think that maybe the market has been overvalued perhaps a few times before, as we talk about Sina based on some indicators we follow. And I think this time around, we're getting pretty close to what some of the all-time highs had been before. And when we've had all-time highs in what's called the Shiller cyclically adjusted price to earnings ratio, usually there's a pretty big tumble after that. And we're pretty close to those levels. Like, Sina, what were some of the ones you were telling me about of where we have been lately with the Shiller PE?
Yeah, so the Shiller PE is coming from Robert Shiller, who is a professor at the Yale University in the United States, and he's a very, very well-respected Nobel Prize winner. And he's got this CAPE ratio. Nobody calls it CAPE ratio. It's called Shiller PE to everyone else, but he calls it CAPE ratio. And the CAPE ratio measures, you could say, the economic weather of the current US economy, so to speak, but it tracks the S&P 500, the 500 most traded companies in the United States, and he's adjusted it for inflation as well. So what we can see is that once Shiller PE is above 30, then as a rule of thumb, the market is perceived as overvalued. And it's not normal for the Shiller PE to be above 30. That's not normal waters, but that's where we are now. And there's been twice in the world history that it's been above 30. And the first time was in 1929, and the other time was in 2000. Third time is right now. What happened the two other times? The market as a whole crashed. 2000 is known as the IT bubble. 1929 is known as the big crash. And that's why when we talk about, oof, we're in a bubble and things aren't looking good, that's how we know that. It's because of the Shiller PE. And what we can see right now is up towards Corona, the Corona crisis and COVID-19, it was actually rising and actually also starting to be kind of, oof, getting in the red zone. And then during Corona, as we all know, stock market dropped as a whole. We had a small bear market. I think it was like 34% or something like that from a previous high during the Corona crisis. I'm not certain, so don't. I could be incorrect, but quite a large fall in the stock market as a whole. So now we're getting back to that same level we were at in 2019. So it looks like, oh, we're climbing upwards. What will happen? We don't know. It can continue to climb over the next many, many years. Who knows? We don't know. What we can say is that twice in world history, when we were at the level we are now, it didn't look too good. So yeah, there you have it. Yay.
Yeah, and I mean, while it's not encouraging, by being aware of what's happening, you can better prepare yourself. And Sina told me how most of the gains of the S&P 500 were driven by the big tech, like the magnificent seven or eight big tech companies that have driven the majority of the returns for the S&P 500 this year. And they were like Nvidia and, of course, the Apple, Microsoft, Meta, Google. Also, Tesla's back up to kind of bigger levels than it was for a while. Like, it was in the tro for some time, even this past year of 2024, and then it's roared back. And it's even seems to have sometimes overtaken Berkshire Hathaway. It's been pretty impressive how a company like Tesla, with a lot of its fans in it and a lot of people who follow Elon Musk, have pumped up the stock, and in a way that's sometimes you would think a little gravity defying. And if you've done your research and homework and you believe that the management is good at Tesla and you believe that it will produce earnings and cash flows that are positive into the future, then good for you if you believe in that sort of company. But I think if you were to listen to some of our suggestions of how we would look into companies, you might have second thoughts about pouring your money into any of the magnificent seven big tech stocks that seem to be having gravity defying price to earnings ratios lately.
Yeah, and usually we don't necessarily talk about these macro trends here on this podcast. So, but I think it's important that you guys are aware of it. So also, I read an article recently where what it said was that the US stock market is showing signs of near-term speculative excess. And what the article described was that indexes like the S&P 500 and the Nasdaq 100 was at their all-time high, while other sectors in the US, and we need to remember these indexes are all about US companies, US businesses. So while the tech heavy companies are flying high, when we look at, for example, something like the Dow Jones, it's not showing the same trends as those high flying stocks. And that's where that speculative behavior is coming in when you see, okay, there are some indexes that actually are stagnant to slightly declining and others that are just rising. Then there's like a mismatch in the overall market. And that's just something to be aware of now. Again, we don't know what is going to happen. Is this going to continue forever? We don't know. And that's where what we could go is we could go back to the fundamentals. We could go back to what we know. And I think it's easy to jump on trends. It's easy to feel like, ooh, I should be doing this. But let's go back to the foundation. Let's go back to Warren Buffett style investing. Let's go back and remember what it is we need to focus on. And where we could start is with the important principle of a circle of competence. So one of the things people often ask about is, okay, but you guys, you talk about these bubbles, but what should I invest in then? And there's many different methods that you can use. It's okay to be inspired by others and listen to, okay, what does other invest in? But make sure to do your own due diligence. Don't just blindly follow what other people is doing. What I often experience is that when we talk about circle of competence, what it means is it needs to be something that you know something about. So it could be your current career, something that's within your expertise or professional area where you actually have some insights into how a certain business model is run or have an understanding of how does this company make money because I've been in that kind of company before. It doesn't necessarily have to be that company that you're in, but it could be a similar type of business, like a fast-moving consumer good or a retail store or something like that, where you have a little bit of insight. So I think that's sort of important to go back to and look within your circle of competence and then come up with maybe some of those businesses, like do some search on, okay, so what is actually publicly traded within that area that I know something about. So
Yeah.
that's a way to start.
And that's exactly the sort of discipline that we're trying to instill on this podcast. When the world seems mad and chaotic and there's the mother of all bubbles happening right now, how do we center ourselves and focus on things that really matter? And like Signe was saying, in your circle of competence, maybe you're somebody who really appreciates great quality makeup products and skincare. And for example, maybe you're a patron of a shop like Ulta and you go there physically, you can experience the products, you know what their service is like. And I mentioned a company like Ulta because I think a lot of our listeners could perhaps relate to this, whether they're a female themselves or they know somebody who is female who might like to have makeup and skincare products. Then you may have heard that even a company like Berkshire Hathaway has invested in Ulta before. They're not invested currently, but it shows that they're really a company that people can turn to as a possibly good company. So we're not saying to go out and buy Ulta, but if you are so inclined and you know things in this industry about skincare and beauty products, you might be able to research a company like Ulta and other publicly traded companies and see if that's something that you would be inclined toward. And I think Berkshire might still have a tiny portion in Ulta, but they've mostly sold out. So I basically, they're not really invested in it right now, but you could try to do some reverse figuring out why did Berkshire have an investment case to invest in Ulta and why might they not be currently? And is Berkshire wrong? Like maybe you might arrive at a different conclusion than Berkshire Hathaway did. So I'm just bringing that up as an educational example. It is not advice. Do not just go into that company just because we said to look into it. It is just something relating back to Signe's point as a circle of competence. If it's within your circle of competence and you know a lot about it, then you should look into it because whether you invest in that company or another one in the industry, if it's something you're passionate about and you naturally care to know things about it, it could be right up your alley in terms of something worth considering investing in.
Yeah, and it's also one thing I want to say because when I talk to my clients about circle of competence, one of the things I experience a lot is that people immediately go to thinking in trends. And so when we discuss this circle of competence, people immediately start thinking about, well, within my area of expertise, I do this, but I think that green energy will be popular in the future or something like that, where they start speculating and where it's like, oh, no, 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 roll back. It needs to be within an area that you actually know something about. So you don't need to actually try to figure out what's going to be trendy in the future. Just stay right here for right now and think about what do you know anything about? Because it's a mistake that a lot of people do is to start thinking about, well, I think that diabetes will be popular in the future, for example, and then they start speculating. However, it's not an area that they necessarily know a whole lot about. The pharma, which is like an industry that's incredibly complex. So it's just a matter of just keeping close to the heart, close to home, and not try to figure out, okay, so I believe this is going to happen in the future. That's kind of the mistake, number one mistake I see, that a lot of people fall into that trap of trying to, what do you think is going to be trendy in the future? Well, it could be, but in the meantime, there could come another product that totally revolutionize. And if it's not something you really know a whole lot about, you wouldn't have seen it coming. Just be aware to stay close to home when you think about things. Or, Michelle, you actually also said something, for example, if it's something that you have a lot of energy about or really want to look into, where you could say, okay, I really don't know a whole lot necessarily about retail, but this store is super interesting to me. So now I'm going to find out about the cyclical behavior about retail stores. I'm going to find out about the little luxury item like nail polish and other kind of lipsticks and that kind of stuff that actually performs well during crisis situation and things like that, and actually start being interested in, okay, I'm interested in this store. So I'm actually also willing to try to figure out something about this sector or area of and actually getting some expertise within it. So that's another thing. But when you're a beginner, it's much easier to start close to home.
Yeah, and if you're finding like, oh, there's not many companies that you can look into right now with what you are more knowledgeable about currently, you could also look to inspiration from some of the best investors, like a Berkshire Hathaway, by visiting a website like Dataroma or Whale Wisdom, and you can see what companies these either fund managers or big company investors like Berkshire Hathaway are invested in. It's according to their 13F filing, which shows what their equity holdings are. And I look at that periodically and I think, oh, Berkshire bought $500 million of Domino's Pizza. Do I want to consider investing in Domino's? I know Domino's, it's everywhere where I am. And even though I never get Domino's pizza, but I know plenty of people who do, should I study Domino's as a possible contender for something to invest in because one of the best investors invested in that? So I might get inspiration from that, not because I love Domino's, but I do love pizza. So I wonder if maybe I could unify those interests of why did company Berkshire Hathaway could have invested in any pizza company, but they chose this one. What is Domino's doing that is so interesting? So that's one way to get some inspiration to spark an investment research effort that you can do and see where that takes you.
Yeah, exactly. And those 13F filings and reports are published every quarter. There was one coming out last time. It was November, mid-November, November 14th. The next one is in February, mid-February. And you can go in, like Michelle says, there are platforms that shows a very nice overview of what investors bought and sold. Be mindful of trying to find Buffett style investors. There are potentially many types of fund managers that potentially are shown on these platforms and that might not necessarily follow the same strategy, and then you can't really necessarily rely on their portfolios and get inspiration there. So make sure to follow. It could be Guy Spear, Monish Pabrai, Lilu. There's Phil Town. There are other types of managers, Howard Marks. I could continue to drop names, but go on, for example, Dataroma. They have a lot of the Buffett style investors in there, for example. So it's a great way of finding inspiration if you don't have that inspiration right now, because a lot of people are like, but what should I invest in next? And for me personally, with this investing style, I've gotten so patient when it comes to the stock market. I remember in the very beginning, I was so eager to start investing using Buffett's principles, and I just could not wait. And it was so difficult. I even made some mistakes back then because I just could not wait. And now I have all the time in the world to wait until those few companies that are on my wish list will be on sale, and then I'm ready. But until then, I'm not worried about the stock market. But of course, I also do have a few holdings right now. I understand when you don't have that you really want to get started. So it's about starting that wish list. And what you could do is also you could use stock screeners where you can narrow down using different kind of parameters in order to actually get a result where you get those Buffett style businesses, quality businesses on the list. You'd still have to look into all of these companies and go into detail about them. Not that you necessarily have to. I remember in the beginning, I spent so much time. I spent months and months and months, but it's really important to get the data. It's all in the data. And then you can always add return on equity, ROE, and benchmark it against ROIC, for example, to make sure that it's not loaded with long-term debt. And we discussed it in previous episodes. I'm not going to go too much into details about it right now, but it's just to also give you, in these days, it's important to focus on your wish list and maybe not necessarily start to invest right now unless there are wonderful businesses that are trading at a discount. Then, woohoo, go ahead, you go. I recently bought some stocks and things like that was actually trading at a discount. So it does happen even though the overall market is high, and now those stock prices have risen since. So yeah, it's just a matter of doing the homework, have a whole lot of patience, and have your wish list ready so you know what to invest in.
Absolutely. And the one stock screener you mentioned, Signe, to me that I think you use is called FinWiz. So people could look into that if you're ready to start collecting the data, if you're at that stage. And yeah, go back, listen through our prior episodes going into detail of these Buffett investing principles, and you'll be well on your way to investing well in 2025.
Yeah. So we're coming towards the end of the episode. Time was flying today. So if you want more information, like Michelle says, go back and find some episodes. For example, from the very beginning, when we launched the podcast, we went into a lot of detail about Warren Buffett's principle. And the great thing about podcasting is that those episodes are still there. They're on YouTube and on all the bigger podcast platforms. So go back and listen. And then we also want to say, have a great week. We'll be back in 2 weeks from now on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.